It starts with a driveway that used to hold two cars and now holds one. In a subdivision outside Columbus, Ohio, a woman in her early 50s backs her sedan out at 6:40 in the morning, drops her daughter at the community college on the way to her own job, and picks her up again 9 hours later. There used to be a second car in that driveway, her husband's truck, paid off years ago, traded in 18 months ago when the insurance renewal came in almost $400 higher than the year before. Nothing dramatic happened to this family. No layoff, no divorce, no medical crisis. They simply looked at what a second vehicle actually cost to keep running in 2025 and decided the number no longer made sense. That decision, repeated in driveways across the country for reasons that are rarely dramatic and almost always financial, is the real subject of this story. For most of the last 70 years, the second car was not a luxury in American life. It was infrastructure. It let one spouse work a different shift than the other. It let a teenager get a part-time job. It let a household absorb an unpredictable morning, a sick kid, a flat tire, a doctor's appointment, without the whole day collapsing. Car ownership researchers at KPMG have estimated that roughly 57% of American households still own two or more vehicles, a habit that took hold in the post-war suburban expansion and never really let go. But that same research points toward a slow reversal, projecting that the two-car household could shrink well below half of all families within the next generation. What's notable is that this shift is arriving not primarily because Americans have stopped wanting the freedom a second car provides, but because keeping that freedom now costs more than many households can justify. Start with what a car costs today, not to buy, but simply to keep. AAA's most recent annual driving cost study put the full yearly expense of owning and operating a new vehicle, factoring in depreciation, insurance, fuel, maintenance, financing, and fees, at roughly $11,500, or just under $1,000 a month. That is the cost of one car. For a household running two, the mathematics stop being an inconvenience and start becoming a second rent payment, or close to it, layered directly on top of the first. Insurance carries an outsized share of that number, and it deserves attention on its own, because insurance is the piece of car ownership that people budgeted for years ago and quietly stopped noticing until it detonated. According to Bureau of Labor Statistics data widely cited by outlets covering the affordability crisis, the average cost of auto insurance in the United States rose by roughly 55% between February of 2020 and late 2025. Other tallies, adjusting for inflation and averaging across all 50 states, put the 5-year increase closer to 30%, with several states, Florida, Nevada, Colorado among them, seeing premiums climb more than half again their earlier cost. Almost all of that increase, analysts note, arrived in a concentrated burst between 2022 and 2024, which is precisely the window in which many households now describe their car insurance bill as something that changed their financial life without ever showing up as a single headline number. The reasons behind that spike are mechanical, not political. Replacement parts got more expensive as supply chains buckled. Vehicles themselves got more expensive to repair, packed with cameras, sensors, and driver-assist electronics that turn a minor fender bender into a 4-figure repair bill instead of a 2-figure one. Medical costs tied to auto injury claims rose faster than general inflation. Insurers, who are required by state regulators to justify rate increases with real claims data, brought that data to state insurance commissioners and got their increases approved, one filing at a time, in nearly every state in the country. None of this was engineered against consumers. It was the byproduct of cars becoming more sophisticated and repairs becoming more expensive, with the bill landing, eventually and unavoidably, on the household holding the policy. Layer financing on top of insurance and the picture sharpens further. The average transaction price for a new vehicle crossed $50,000 for the first time in 2025, up more than 30% from where it sat 5 years earlier. Financing data from Experian shows the average monthly payment on a new car climbing past $770 by early 2026, with used car payments trailing but still averaging over $500 a month. Interest rates compound the pressure. New car loans have hovered in the range of 6.5% to 7%, but buyers with weaker credit, often the same households already squeezed by rent and insurance and grocery costs, pay considerably more, with some subprime borrowers financing used vehicles at rates above 20%. By the final quarter of 2025, more than 1 in 5 new vehicle buyers who financed their purchase we're paying over $1,000 a month for that single car. Cox Automotive data shows that new car buying has increasingly become concentrated among higher earners. Nearly 43% of new vehicles sold in the most recent year went to households earning $150,000 or more, up from a third of buyers just 5 years earlier. The vehicle market has not simply gotten more expensive. It has quietly resorted itself so that a segment of ordinary earners who once bought new cars as a matter of routine can no longer credibly enter that market at all. None of this shows up as a single traumatic event in most households. It shows up as a driveway conversation that happens more than once, usually around the time a lease is ending or a check engine light comes on in the older of two vehicles. Consider a household earning around $90,000 combined in a mid-sized metro with a mortgage, 2 teenagers, and 2 vehicles, one financed, one older, and paid off. This is not a poor household by any conventional measure. It is, on paper, comfortably middle class. But run the actual monthly obligations, a mortgage payment that reflects a house bought at a rate several points below where rates sit today, a car payment on the newer vehicle approaching $600, combined insurance for 2 vehicles now running close to $300 a month, nearly double what it cost the same household 5 years earlier. Fuel for 2 commutes, routine maintenance on an aging second vehicle that increasingly needs more than oil changes. None of these are optional line items. None of them can be canceled the way a streaming subscription can. When the older car needs a new transmission, the household faces a stark choice. Spend $3,000 to keep a car with 140,000 miles on it running for another year or two, or take on a new loan at current rates for a replacement that will immediately cost more per month than the mortgage did when they first bought the house. Increasingly, households in this position are choosing a third option nobody planned for. They fix the newer car, sell or scrap the older one, and become a one-car family by subtraction rather than by design. The average age of vehicles on American roads has climbed to a record high of roughly 13 years, a statistic that on its surface sounds like a story about durability and improving engineering. It is also a story about what happens when replacing a vehicle becomes financially riskier than nursing an old one along. Independent mechanics across the country report the same pattern. Customers who once traded in a car every 5 or 6 years are now asking for the cheapest possible repair to buy another 12 months, not because they don't understand the math, but because they understand it perfectly. A used vehicle now carries a 5-figure price tag on its own, and an aging car that is already paid off, whatever its flaws, comes with no monthly payment at all. That single fact, no payment, has become one of the most valuable financial features a vehicle can have in 2025. More valuable in many households' calculations than reliability, safety technology, or fuel efficiency. The decision to go from 2 cars to 1 does not look the same in every zip code, and treating it as a single national story flattens something that actually varies enormously by geography. In a dense East Coast or West Coast metro with functioning public transit, dropping a second car can be almost painless. A household in inner Boston or Chicago that gives up a rarely used second vehicle may save several $100s a month with only a mild inconvenience in exchange, since a subway pass or occasional rideshare fare can absorb most of what that car used to provide. But the overwhelming majority of American households do not live inside that kind of transit network. In suburban Ohio, exurban Texas, rural Georgia, or small-town Montana, a car is not a convenience layered on top of other transportation options. It is the only transportation option. Federal Highway Administration data shows that more than 90% of American households maintain access to at least one vehicle precisely because so much of the country was built around the assumption that everyone would drive. In these places, going from 2 cars to 1 doesn't reduce a household's mobility modestly. It restructures the entire week around a single shared vehicle, with one spouse dropping the other at work before continuing on to their own job, arranging pickups around shift schedules, and losing the ability to respond quickly to anything unplanned. A sick child, a canceled shift, a family emergency 2 towns over. Generation matters as much as geography. Baby boomers, many of them now retired or approaching retirement on fixed incomes, are giving up second vehicles for reasons that are partly financial and partly about right-sizing a life that no longer requires 2 commutes. Kiplinger's retirement research notes that more than 40% of American households already get by with 1 vehicle or none. a figure skewed heavily toward retirees who no longer need a car for daily work travel and are recalculating whether the insurance, maintenance, and depreciation on a second vehicle still earns its keep against a fixed Social Security check. Surveys conducted around vehicle purchasing intentions found that roughly two-thirds of baby boomers surveyed said they had no plans to buy or lease a car in the coming year, a striking figure for a generation that spent decades as the most reliable car-buying demographic in the country. At the other end of the age spectrum, younger Americans are pulling back for a related but distinct reason. Many of them are simply priced out of car ownership before they ever build the habit. Survey data from mobility researchers found that more than half of surveyed Gen Z and millennial respondents said they were likely to consider alternatives to buying or leasing a car altogether, citing the combined weight of vehicle prices, insurance, and financing costs. For a 25-year-old renting an apartment in a metro with any kind of transit or rideshare access, the math increasingly favors avoiding car ownership entirely rather than financing a $700 a month vehicle on an entry-level salary. It's the middle generation, people in their 40s and 50s, raising teenagers who are just old enough to need their own transportation to school, sports, and part-time jobs, where the second car decision becomes most psychologically loaded. This is the generation most likely to be caring for aging parents at the same time they're raising children, the so-called sandwich generation, and it is also the generation most likely to have built a household budget around the assumption that a second car was simply part of a stable adult life, the same category as a mortgage or a retirement account. For a parent in this position, giving up the second car doesn't just mean rearranging a commute. It often means telling a 16-year-old with a fresh driver's license that they will not, in fact, be driving themselves to school this year, an ordinary rite of passage that has quietly become a financial decision instead of a developmental one. Here is where the story deepens past its opening premise. It would be easy to describe this simply as a case of rising costs outpacing incomes, and that's true as far as it goes. But the more revealing pattern is not that Americans can no longer afford cars in general. Vehicle sales, while below their pre-pandemic peak, have not collapsed. The more revealing pattern is that the second car specifically has become the shock absorber that households are sacrificing first, precisely because it was always functioning as a buffer rather than a necessity. A household's first car is non-negotiable. Without it, most people in most of the country cannot get to work at all. The second car was the flexibility built on top of that baseline, the thing that let a family handle two schedules, two emergencies, two lives running in parallel without friction. What's disappearing first, in other words, is not mobility itself, but the margin around mobility. And margin, as it turns out, is exactly what has been disappearing across nearly every category of household spending over the last several years. Not the essentials, but the slack that used to sit around the essentials and made ordinary life feel survivable rather than exact. That reframe matters because it connects the second car story to something larger happening inside American household finances. Federal Reserve Bank of New York data shows total household debt reaching a record $18.5 trillion by late 2025, with auto loan balances alone standing at roughly $1.66 trillion. Delinquency transitions into serious late payment on auto loans have remained elevated compared to pre-pandemic norms for several years running, a signal that a meaningful share of households financed vehicles at payments they are now struggling to sustain. This is not primarily a story about reckless borrowing. Most of these loans were originated at payments that looked reasonable at the time, based on incomes and interest rates that have since shifted under the borrower's feet. A car payment agreed to in 2021 at 4% interest looks very different by 2025, after insurance has risen 50%, after a job changed, after a raise that never quite kept pace with the renewal notices arriving every 6 months. This is where the pressure chain becomes visible in a single household rather than in aggregate statistics. Picture a two-income family with a combined income in the low six figures, comfortable by national standards, not wealthy, carrying a mortgage, two car payments, and the ordinary costs of raising children. One earner's hours get cut, or their job disappears in a round of efficiency layoffs that has become common across white-collar and clerical work alike, as companies lean on automation and AI tools to reduce headcount. The mortgage doesn't change. The insurance renewal doesn't wait. The first month, savings cover the gap. The second month, a credit card starts absorbing what savings can no longer reach, and that balance, once opened, becomes its own fixed monthly cost, carrying an interest rate far higher than either car loan. Something has to give, and increasingly, the something that gives is the second vehicle, sold, not because the family doesn't need it, but because it is the single largest recurring obligation they retain any control over, the mortgage they can't easily unwind without moving. The first car, the one that gets the remaining earner to their job, is not up for negotiation. The second car is the only lever left, and pulling it is less a financial strategy than an act of triage. It would be inaccurate, though, to present every household giving up a second vehicle as a family in crisis. Some of this shift reflects genuinely available options that simply didn't exist a decade ago. Remote and hybrid work arrangements, which expanded dramatically after 2020 and have persisted for a meaningful share of white-collar employees, have quietly eliminated the daily commute that once justified a second vehicle in many two-earner households. If one spouse works from home 3 or 4 days a week, the math on maintaining a second full-time vehicle changes substantially, and the decision to drop it reflects adaptation rather than desperation. Rideshare and short-term rental services, while imperfect substitutes for daily commuting in most of the country, have made occasional access to a second vehicle possible without owning one outright, particularly in metro areas. And some households making this shift are simply recalibrating lifestyle choices that had drifted upward, a third vehicle that had become a status symbol rather than a necessity, a lease renewed reflexively rather than deliberately. Not every second car given up represents a family in financial distress, and it would be dishonest to suggest otherwise. But the honest accounting also has to acknowledge which households have no such flexibility. A household in a rural county with no broadband, where remote work isn't an option and the nearest grocery store is 20 minutes away, cannot substitute a rideshare app for a second vehicle because no rideshare drivers operate there. A family where both parents work fixed shift jobs, a nurse on a rotating schedule, a warehouse worker on an overnight shift, cannot simply coordinate around one shared car the way two flexible office workers might. For these households, the loss of a second vehicle is not a lifestyle adjustment. It is a real reduction in the family's capacity to earn income, care for children, and respond to emergencies, and it tends to fall hardest on households that already had the least room to absorb it. There's a quieter layer beneath all of this, one that rarely gets discussed openly because it doesn't fit neatly into a budget spreadsheet. Giving up a second car changes how a family experiences its own independence, and for many people, especially those who grew up in households where two-car ownership was simply what a stable adult life looked like, the change carries a weight that has little to do with logistics. A father driving his working-age daughter to her shift, because the household no longer has a car for her to use of her own, describes it less as an inconvenience and more as a step backward, a reversal of the independence a car was supposed to represent. Parents describe a particular kind of quiet embarrassment explaining to a teenager why, unlike their friends, they won't be getting a car for their 16th birthday, not because their parents don't believe they're ready, but because the family's insurance bill would rise by another few $100s a year the moment a new driver's name was added to the policy. None of this gets said out loud to neighbors or coworkers. Most of these households still look from the outside entirely stable. Same house, same jobs, same school pickup line. The car sitting empty in the driveway, or simply not there anymore, is one of the few visible signs that something underneath has shifted. For households actually working through this decision, the available responses come with real trade-offs rather than easy fixes. Carpooling with a neighbor or coworker can meaningfully offset the loss of a second car, but it requires coordinating schedules with someone outside the household, a fragile arrangement that collapses the moment either party's job changes. Shopping aggressively for insurance, something LexisNexis data shows more drivers doing than at any point since it began tracking the behavior, can shave real money off a premium. But the savings are usually measured in tens of dollars a month, not hundreds, and they don't address the underlying rise in repair costs driving rates upward in the first place. Extending the life of an aging vehicle through diligent maintenance defers a car payment but not indefinitely, and a major mechanical failure on a car with no trade-in value left can turn a delay into an emergency. Multi-generational households, where an adult child moves back home or a grandparent moves in, sometimes solve the car problem by consolidating vehicles across 3 working adults instead of 2, but that arrangement solves a transportation problem by creating a privacy and autonomy problem that families are often unprepared for. None of these options make a second car unnecessary. They only make its absence more survivable, and only for households with the flexibility to use them. What connects back to that Ohio driveway, and to millions like it, is not a story about Americans falling out of love with cars, or suddenly discovering the appeal of walkable neighborhoods, or embracing some cultural shift toward minimalism. It is a story about a piece of infrastructure that quietly became too expensive to maintain in duplicate. A car has always been one of the most expensive things an American family owns, short of a home. What's changed is that owning two of them no longer functions as a modest upgrade to convenience. It functions, for a growing share of households that would never describe themselves as struggling, as a bet that nothing in the next 12 months will go wrong. No rate hike on the loan, no insurance renewal shock, no cut in hours, no unexpected repair on the older car. Families who once made that bet without a second thought are now, one driveway at a time, deciding they can no longer afford to make it twice.